Zoom Communications announced their earnings after the market closed, and their earnings were not that bad. There are some highlights in the report. The stock is trading down a bit. Let's take a look at the earnings and see what we've got. So the company grew the fourth quarter by 3.3% if you look at revenue growth. And for the year, they grew revenue by 3%. Now, that's not very good revenue growth, but it is revenue growth. The company keeps getting bigger. And what's impressive is they're getting bigger customers. They're really doing well in attracting big enterprise customers that buy a lot of seats of Zoom software. They actually grew big customers by 7.3%. What was really impressive is they grew their free cash flows by 21%. That enabled them to buy back a lot of shares. They rebought 4.3 million shares of stock in the fourth quarter. So that's going to make each stockholder of Zoom own a bigger fraction of the company. That's all positive. So the free cash flow growth is really high. The company's really profitable. I'll show that in a little bit. Now the market has been selling off for the last 4 trading days. So the stock market's kind of crummy. The company has been selling off by about 2%, and I don't think that's all that bad. But let's take a closer look. Year to date, Zoom is pretty much down about 0.62. After today's losses, it'll be down about 2.5. And over the course of 1 year, it's up 28%. The 5 year looks pretty ugly because this was a COVID era darling. Everybody thought that we were never going to go back to the office and everybody was going to be pretty much on Zoom forever. And that wasn't the case. But the company continued to grow while the stock price really plummeted, which was, I thought, an opportunity. I'm making money on the stock, but I don't think I'm making enough money. I'd love to have doubled my money. I've held the stock for about 2 years. And to this point, it's made a decent return, but I'm not looking for decent. I'm looking for a really good return. What is interesting about Zoom is that it's a $25 billion market cap company. Its revenue is 4.63 billion, and the PE is nice and low at 15. It is still growing. It's a very profitable software company, and it generates tremendous cash flow. It is not a crowd favorite. So analysts, a lot of them cover Zoom, but they have a hold rating and they say it is discounted by 9%. Zoom has continued to grow. They did have some years where the growth was staggering. In 2020, 88%, 325. And what is really impressive is they've continued to get bigger, doing the same thing, growing organically. And that is really impressive. When we look at their free cash flow, it has grown tremendously. A lot of companies would love to have this growth in cash flow that Zoom has experienced. They would also love to have Zoom's margins, gross margins of 75%, profit margins of 20%, free cash flow margin of 37%. Man, these are make-believe numbers, but I'm here to tell you these are real. Either that or management's in big trouble. Now, when we look at their forecast, we have 23 analysts covering the stock, and they're a little divided. Worst case scenario, the stock's going to go down to 60. Best case scenario, it's going to go up to 115. And overall, they are looking for the company to continue to steadily grow just a little bit at a time, 3% at a time, close to 5% in 2028. Their earnings per share, though, are expanding nicely. So that looks good. And they have a low PE. So now let me do a valuation on the company and share with you what I think the company is worth and whether they're discounted or being sold at a premium. Now, I think that Zoom, if you look at the value of their cash flows and their earnings per share, is discounted by 59%. That's a really nice discount. Their cash flows are staggering, just really good free cash flows, and they keep growing them. And conservatively, I'm just growing my projection, this forecast that I've created by 5% and long-term by 4%. I think they're going to beat that, but let's be conservative. Those cash flows just keep adding up. And the intrinsic value of those cash flows is $36 billion. They have close to $8 billion of cash on the balance sheet. And that's after buying back a high number of shares. They have no debt. And the equity value combined, when you add that cash, is 44 billion. Market cap's only 25. So there's a big discount on the free cash, the value of the free cash flows based on a 9% discount rate. So that's just really attractive, I imagine, to somebody who would want to acquire Zoom. You think about what they're acquiring: healthy business, high margins, high cash flow, and maybe they paired up with another software could be a more formidable combination. And that might be interesting. Maybe a bigger company like an Adobe might acquire them. and really be competitive in the video conferencing market. Who knows? Maybe that'll happen. Earnings per share is very positive. I give them a PE of 18. They are growing, high margins, high cash flows, zero growth rate. They're still discounted by 23% if I use those factors. So a 59% discount is very good. I have a healthy position of Zoom. I am not loading the boat with Zoom shares. I own a fair amount, and I'm just going to hold my position. I think Zoom is going to be acquired, or the market's just going to fall in love with their cash flows again, especially since they're buying back so many darn shares. For all I know, Warren Buffett's going to buy Zoom because he loves companies that buy back shares. And he kind of coached Apple in how to make their stock more valuable when they're not growing. So maybe Warren Buffett would be a great investor and a mentor to the team that runs Zoom. So that's my video on Zoom. I hope you found it interesting. I'd love to hear what you think on Zoom. Let me know, good and bad, what you think. Appreciate you watching. Good luck.